Carl, thanks. The Federal Reserve out with a report about the failure of Silicon Valley Bank, in which it will blame SVB, it will blame the supervisors, and it will talk about changes that need to be made. In the first case, it says that SVB was a textbook case of mismanagement, that it failed to manage basic interest rate and liquidity risks as well. But the supervisors at the Fed failed to take forceful enough action. After they recognized these problems, they missed the risk created by SVB's meteoric growth during and after the pandemic. For example, the bank failed before SVB could be downgraded, even though downgrade discussions began months earlier in November. It demonstrates weaknesses in regulation and supervision, according to the report, and regulatory standards for SVB and indeed for banks its size were too low, the report says. Also, some blame here for the board of directors who failed to oversee senior leadership at the bank. Among the key findings, social media and technology combined with a concentrated deposit base that may have made fundamental changes in the speed of bank runs. Banks, it finds, can create contagion even if they're not that big or even that highly connected in the system. And the Fed should boost capital liquidity requirements for firms that don't meet certain standards, even the ones that are the obvious ones, but other standards as well. It should toughen rules on unrealized gains and losses on the available for sale portfolio and also on compensation programs for executives. The vice chair for bank supervision, Michael Barr, says in a release, we need to develop a culture that empowers supervisors to act in the face of uncertainty. In the case of SVB, supervisors delayed action to gather more evidence, even as weaknesses were clear and growing. This meant that supervisors did not force SVB to fix its problems, even as those problems worsened. SVB, it turned out, had 3 times as many supervisory findings compared to its peers by the time it failed. There was 31 of them. The Fed should rethink changes to the supervision it made in 2019, going back and sort of having a problem with the changes made under Randy Quarles, the Trump-appointed vice chair for supervision. And then Fed Chair Jay Powell finally is recommending or saying he welcomes the report's recommendations. Carl, Melissa?
One question about what you just reported, Stephen. You mentioned they had 31 of these supervisory provisions. Are these like red flags? They're like speeding tickets, like, hey, guys, you're doing something wrong. There are 31 of them out there?
Yeah, there's parking tickets. They're kind of like parking tickets. I guess there are 2 kinds of parking tickets. Maybe there were parking tickets written on manila ticket paper and ones written on red ticket paper. There's the MRAs and the MRIAs, matters requiring immediate attention and matters just requiring attention. But there were a whole boatload of them for SVB, and there were a lot of them out there in the system. And the report talks, Melissa, about the inability to get from MRA or MRIA to actual action. And it seems like there's this incredibly, and I've reported on this, incredibly bureaucratic process where there's supervisors in San Francisco. There are committees of supervisors that are designed to make sure that all the banks in a certain size are treated the same. And then there's the supervisors back in Washington at the Federal Reserve Board. It's a very Byzantine system, it sounds like to me.